Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting today again with Michael Porter. Hello, Michael.
Yeah, morning, Robin.
So, Michael, last week, bit of excitement. We had ceasefire, Straits of Hormuz supposedly coming open again, and our market boomed on Friday. We're filming on Monday. Oil came down under $100 a barrel. The rand roared back. So it's all over. Excitement, is it?
Yeah, I'm back from holiday, but yes, reality sort of sets in, Robin. Yeah, Robin, I think it just goes to show exactly how volatile things are. On Friday, obviously the key headline was that the Straits of Hormuz would be reopened and that shipping would be free. That unraveled over the weekend with skirmishes on both sides, I think is probably the polite way to put it. And oil prices did fall actually below $90 a barrel on Friday afternoon. They got down to sort of 88 or 89. This morning they're back up at 95. I think what is happening though, Robin, is that the probability of, I think markets are looking through and seeing that there is an end to the war coming. So whether it's this week or next week or the week after, the propensity for, listen, there's a lot of rhetoric and there's a lot of backwards and forwardsing, and there's been the taco trade again once or twice where obviously these deadlines and threats have been put in place and they haven't materialized. So, but I think generally the market's reading of the situation is that the end is in sight, but whether that's a week or 2 or 3 away, no one really knows. Yes. I think what is probably more concerning is that some of the damage that's been done is going to take a long time to fix. So I don't think that we can just assume that when the war's over, when the straits are reopened, I mean, oil prices might drift back into the 80s, which would be very welcome, but I don't think we should be expecting them to be back at $60 or $65 a barrel. Yeah. You know, just in January, oil prices were probably closer to $60 a barrel. The rand was pretty strong. That meant that the rand oil price, the price of a barrel of oil in rands was 1,000 rand a barrel.
Yes.
That hit 2,000 rand a barrel at the height of the conflict when oil was 115 or 100, somewhere around there. It's now back at about 1,400 rand a barrel. Okay. So again, that's obviously good news for the petrol price. I mean, and obviously diesel's a little bit different because of obviously also the refined products and things. But because government's given us a subsidy, it'll probably be a while before petrol prices really fall. I mean, it might be a couple of months where petrol prices at best stay flat and they don't really go up. I don't think there's really been an indication from government yet whether they're going to extend the subsidy into May. It's probably likely, but I don't think they can do it indefinitely. So it'll also help them if they're not providing a sort of 6 billion rand subsidy per month. Maybe it's only 1 billion or 1.5 billion. That will also take the pressure off. So there's quite a lot moving around, but yeah, it's it's fun and games at the moment. Headline watching. Markets are headline watching.
And Michael, do we need to be concerned about? I mean, I know there's this whole thing, rush to the petrol stations, and Gauteng ran out of diesel and what have you. Is that a concern, or are we getting our oil into the country? And
Robin, I don't. Everything that I read, there's not a shortage of fuel per se. I mean, I think there's two things. I mean, this is, I suppose, where Sasol comes into its own a little bit when you've got, or we've got obviously a couple of refineries, and we've got Sasol. So we are getting some crude from other places. I think one of the challenges is that it's not just crude that comes out of the Gulf. It's a lot of finished product as well. It's a lot of diesel. It's a lot of fertilizer. It's a lot of other bits and pieces. So one of the reasons why diesel is so much more expensive now is because the refined products have also been affected, So I don't think there's a shortage in this country, Robin. I think that it's probably quite natural what happened at the end of March. Everybody was looking at this massive price increase on the 1st of April, and you're going to go and fill up your car and you're going to go and fill up a few jerry cans because the price increase is enormous, and government only came out really a day a day or two before and said no, there would be a subsidy. So everybody was panicking and trying to buy diesel at a lower price, even if it's only for a month. It makes a difference, if you're buying 5,000 liters of diesel for your farm or something or whatever. So I don't think there are shortages now that the sort of maybe a normal pattern is establishing itself. And I think what you will have, Robin, is people being a bit more thrifty, especially on the consumer side. I know businesses might be a little bit more inflexible, but on the consumer side, you'll have more carpooling. You'll probably have a little bit more working from home, and just things where people can try and save a little petrol. It makes sense, and it actually makes sense for people to be as flexible as possible, just to bring down that cost.
And Michael, I mean, obviously, oil price is the big one, but I know you've been looking at and updating some of your long-term commodity charts, and South Africa is a commodity producer. It's not all bad news from our perspective, is it?
No, Robin. We said a couple of times that this whole long trend in the weakness of the dollar, I don't think is going away. It's been temporarily arrested by the sort of flood into safety with the war, but I think that trend is re-establishing itself quite quickly, and the dollar is starting to weaken. So the gold price is almost a mirror image of that, and it's jumping around. I mean, as oil prices go up, the gold price goes down at the moment. You would think it would be the other way around, but there's a close correlation. But copper prices are at record highs almost. The other one that's actually really going to start biting a little bit is aluminium prices. Aluminium prices are almost at record highs. And it's not because there's insatiable demand for aluminium, it's because supply's been taken out. I mean, quite a lot of the big, people will probably know that Mosul Aluminium was a big smelter in Mozambique that was built by BHP Billiton. It was then put into South 32 when they demerged. But that closed in March because they couldn't agree on a power contract anymore. It was built on cheap electricity, and that doesn't apply anymore. But a lot of the big aluminium smelters are in the Gulf because there's abundant electricity and energy, and these smelters are cheap. And now they can't get the aluminium out, and those smelters have been partially or maybe a little bit damaged as well, or with a bit of debris or whatever the case is. So aluminium prices are high. That means, if you think about what aluminium's used for, I mean, we're doing some building, all the aluminium windows, you think about tin cans, all those kind of packaging, all those, sorry, not tin cans, aluminium cans, all the packaging, all just starts to feed through. So that's where the inflationary impact does come through, unfortunately. So yes, we are benefiting. Platinum prices are edging up, copper prices are strong, iron ore, coal prices are all pretty firm. But there's some high commodity prices are not all pointing to a bullish scenario. There's actually a bearish element in there.
As well, Awesome. Well, Michael, thanks for giving us that insight. It's always good to get a slightly bigger picture.
It's nice to be back.
Yeah, well, it's good to have you back in the country and in the office. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.